Welcome. Welcome, everyone. It's Angelo Robles, and welcome to my Family Office TV. And for my members of SFO Continuity that could further participate live and interact, welcome. Today, VC myths, family office access, and Fintech next big bets. That's a lot to cover, but we have a great guest who I've known for many a year in terms of covering it. Our special guest today is David Teten, partner at Coolwater Capital. He is a leading expert in venture capital, tech stacks, and how investors in private markets can leverage technology, opportunity, and access for a competitive edge. I think we'll all agree that we're in the midst of, it's not upcoming, we're in the midst of a massive shift. And AI is definitely going to be a part of that, transforming investing, family offices, redefining strategies. And the traditional VC model, angel model, early investment model, entrepreneur model, any word you want to use, is being disrupted before our eyes. So I look to deliver with our special guest today real actionable insights for investors, for family offices, and really decision makers who rather bluntly don't want to be left behind. Among the multiple topics within that realm that we'll be covering today, getting into the best deals, VC myths and lies, to be honest with you, the future of venture capital, AI and fintech, next big bets, liquidity and exits, asymmetric opportunities, and honestly, much more. On that note, David, it's been a long time. Welcome. Good to see you.
Thanks for having me.
So we have so much to cover. Let's get right to it. How, and we're going to bounce around all those subjects and come back to multiple questions within it, but to keep the conversation flowing, I think this would be the best way to do it. How are family offices currently using tech and analytics, and how should they be optimizing that?
So I'm going to zoom in on my area of particular expertise, which is investing in the private markets. I know a little bit about family offices more broadly, but I'm not going to claim to be an expert there. So I could talk about the phenomenon I see of family offices and more generally private equity, VC funds, creditors using modern AI tech and analytics. The model here is in the public markets, there's a multi-decade trend towards use of greater automation, greater data-driven approaches, firms like Two Sigma, D. Shaw, Renaissance. But in private markets, most firms are nowhere near that savvy. For many firms, their technology is Excel and Salesforce.com, and not all the partners are even using the CRM. So I see a lot of room to do it better. And I think the next generation of elite players in the private markets are going to be using these modern tools and going to be changing their processes and their culture accordingly. So in the public markets, firms like D. Shaw, when they are using AI to inform their investment approach, they spend maybe 80% of their calories on what they would call trade selection, trade weighting, things like that, right? In our world, in private markets, there's a very different dynamic because almost everything is manual. In the course of investing in privates, there are many different steps, right? You need to manage your internal operations. You've got to source the deals, diligence the deals, execute the deal, manage it for the next 5, 10, 15 years, find an exit, and that's all manual. And so I think at each of those stages, there are different ways to use modern tools. For example, one of the best practices I see in sourcing is figuring out ways to build a brand for yourself to source the right deals. If you market to the world as, hey, we're a pool of capital and we'll invest in anything that's attractive, it's really hard to be memorable, right? Because that's not memorable. That's just saying you have money. But if you market as we're family and we made our money in real estate and we're interested in deals that are accretive to or can leverage our real estate portfolio, okay, it's a little more differentiated. And there are a variety of modern tools that can help you generate, for example, on-brand content for social media channels to keep the market informed and make you top of mind for deals in prop tech that are relevant for your particular family. Another huge pain point is just corresponding with all the players. Because our industry is so relationship driven, you have to figure out a way to be responsive, be top of mind for the bankers, for the co-investors, for the other families. And so, for example, Superhuman, which is my email client, has a nice built-in AI tool that generates draft email responses based on your past correspondent patterns that you can use to speed up your engagement with people. There are also a variety of tools like Wokelo, which will use AI to generate investment memos for a deal that you're considering using the data that you source. In other words, you pump in the sensitive internal information you have about a deal, and it'll use that to write a memo. And so another last area that I'll highlight is monitoring portfolio. So there's a company called Synaptic, which is a major data provider, and they recently launched a service that takes the data about your portfolio companies and absorbs it into one standard platform. So in other words, the portcos might be keeping data in QuickBooks and NetSuite and different platforms, but they're all inconsistent, right? So it's very helpful to pull all that data in. Synaptic uses AI to do that and then adds a layer of human analysis on top of it to double check everything so that you have proper reporting of what your assets are worth.
I think most people would agree that family offices are normally, there are some incredible exceptions, but normally not on the cutting edge of technologies in a variety of ways, utilizing for practice management, office operations, and investing. What do you think are the barriers for this, and how could family offices adapt quicker to tech-driven solutions?
So one big barrier is the family office ecosystem uniquely is particularly opaque, right? In other words, if you're running a car dealer and you want to benchmark how other car dealers operate, it's really easy to find them and figure out how big they are and how sophisticated they are. In the family office world, that's much harder to figure out who are your peer institutions at your level of wealth and sophistication. Another big issue is the fact that money does not equal intelligence, and even intelligence in one domain doesn't equal intelligence in all domains. So there's definitely a pattern of thinking I see in successful founders, which is they think because they are successful running their real estate business, they're really, really good at a bunch of other stuff, and that is definitely not automatically true. You need to either educate yourself about technology or get a consultant who knows what they're doing in order to not make mistakes because you're being overconfident in your own abilities.
True. My little bit of an issue with some, I did not say everyone, some consultants in the family office community, they're wonderful. They're way ahead of the family offices. They're a little bit built, and one of my favorite words lately, on a little bit what I define as legacy solutions. They're very trained in certain programs. They're comfortable with the management team of those organizations, and they're very fluid in terms of how to execute it. And relative to what most family offices are doing now, it is an improvement. Now, you do have to gauge time to properly install and update and get the staff familiar. Are they going to utilize it? And it is going to cost money. You may get better analytics to make better decisions. But my little problem with that is a lot of that is built in what I define as a pre-AI world. And things are different now. There's lots of new technologies built on AI platforms. Most of what's out there in the family office world, they don't want to adapt to an AI platform. It's going to cost them money. It's going to take them time. And they have actually, some of them have incredible profit margins relative to what we're doing now. Now, I admit we're getting more into the nitty gritty of a family office ecosystem that I know is not where you live and breathe every day, but you've been in them. You've had much access in the world of VC, of family offices and technologies. Do you see this being a problem that effectively family offices are not adapting quickly enough? They don't know what they don't know. They don't know who they don't know. And maybe they're using some of the wrong sources to optimize their operations.
Yeah, it's certainly a missed opportunity, right? So what's a definition of family office? One definition that I like is a family that's managing the money as their core activity, right? They're thinking about it the way a institutional money manager does, right? Their job is grow the assets by a target X% and don't lose too much money, et cetera. So if your job is to manage and grow that pool of assets, right, then it's your fault if you're not taking advantage of modern tools and you're losing alpha or you're creating unnecessary risk for the family by making yourself vulnerable, by having inefficiencies. In particular, I would differentiate between performance alpha and operational alpha. Right? Performance alpha is you make a great trade, you invest in a great fund, you make a lot of money, great, right? We all aspire to that, but it is inherently unpredictable, unpromisable to your backers, to your internal or external clients. Operational alpha is much more predictable, right? If you have a well-functioning shop, if you have processes in place to make sure your data is correct, you're not missing opportunities, you're thoughtful about things, then you can confidently say, we're not going to make dumb errors. We are taking advantage of the assets that we have in order to do our job well of stewarding these assets.
That's an excellent point. I think one of the questions that I'm most looking forward to is, from your perspective, the challenge in family offices in achieving their goals and utilizing either technologies or investing more aggressively into earlier deals and VCs that I define as a principal and agent problem. Simplifying that, and I think many family office executives are of character, they're well-meaning. I don't know if many of them are what I would define as great. To me, if you're going to have a family office, be incredible or don't have one at all. And it's on you if it's not incredible. The buck stops with the family. But how do you address the issue? This is probably more putting on your pure VC hat now, that the principal may have made their money, understand risk, and is willing for a percentage of their portfolio to be more aggressive in their allocation. However, the non-family, the executive, may be concerned about, well, Warren Buffett said, rule number one, don't lose money. Rule number two, remember rule number one. But the impact of inflation, of family expenditures, of lack of further entrepreneurship and engagement of the rising generation, decade after decade, will take a terrible toll on that family if they're ultra conservative. How do you address the issue, maybe again wearing the VC hat, of how do you understand whether I should be dealing with the principal, a family member, or an executive, and how do you weave your way through that political landscape?
Well, if you're an outside consultant or outside fund manager, then no surprise, you always want to try and get to the most senior decision maker you can. Typically part of your job, in fact, is to get through those gatekeepers. If you're inside the family office, and I've been inside of a number of family offices in different roles, then part of the dynamic that I've seen is figuring out a way to make sure that the family principals are finding the right advisors and setting up incentives in the right way for them to think properly. One dynamic that I'll highlight is careers. So 20 years ago, family offices were not really a systematic option for finance people, right? It was very ad hoc and inefficient. And now family offices in some cases are competing with the Goldman Sachs and Morgan Stanleys for new MBAs or for the MBA with 2 years experience at a private equity shop, right? So they have to compete with the major players in terms of providing a career track. And a friend of mine who's CIO of a billionaire family office said, after the GFC, the global financial crisis, suddenly a lot of that ecosystem, that talent pool, realized the family offices are only people who control their own capital. A lot of other employers, right? Suddenly they had drawdowns, they did not have control of their capital, and they had to lay people off. And the family offices typically did not do that, right? Because they had more long-term thinking. So going to an earlier point, you have to manage it like a business, right? You have to give people appropriate upside economics. So they think about it as a long-term employer, not a place where you put some points on the board to get a better job elsewhere, right? That's not a good way to build a long-term institution, which as a family, right, you should be thinking very long-term.
Indeed. I did an interview last week with perhaps the most prominent attorney in the family office world, Patrick McCurry, and basically 98% of it was on effectively compensation and strategies to attract people. Wouldn't expect that from talking to such a prominent attorney, but that's like the number one thing that he finds the unique nuance between the family and being adequate and being mediocre. You're really, I'm sorry, you're being great. You're really only as good as your people. Therefore, attracting the right people, understanding things like carry, but carry has no downside risk, arguably, for the executive. So how about carry and or co-investment or bonus up and gross up for some bonus and tax structures within that to help make it attractive, but also give some skin in the game to the executive. Now, again, we could spend 2 hours on that subject alone. Actually, this is a question that I think is really important for a lot of people on the line today. A lot of family offices are interested in investing directly in the companies, but they don't want to lead rounds. How can they get invited to lead rounds?
So the number one most common request I get from families is, can you help get my kid an internship? And number two is, How do I join rounds led by reputable VCs? So this is a ridiculously common request. And as a result, it's very, very competitive. And there's this whole ecosystem of syndicators and so on who figure out ways to get into the deal that Sequoia is leading, and then we'll market it out and get fees for it. So I find this sort of humorous because this is very different than the way hedge fund land works. In the public markets, most hedge fund managers will brag, I'm not a momentum investor, I'm a value investor, right? I find these off the beaten track deals, no one's aware of them. But it is super common in VC for people to brag about getting the super hot deals that everyone else hears about. You can see the irony, right? Those deals, by definition, tend to have higher valuations, perhaps less investor favorable terms, precisely because everyone is crowding into the deal. Some of those deals make lots of money, right? But I will highlight that's different. So to your question of how do you get in these deals? So the first and best way is to lead the round, then you control it. But then most families don't qualify as being prominent lead and reputable lead investors. The next is invest in a lot of VC funds and tell those funds that your investment in them is designed so that you get the first call when there's a co-invest opportunity, and that you are tracking that metric diligently, and you're not going to re-up if they don't invite you into some attractive rounds. The next level down is invest in one fund and tell them this is a strategy, right? So you're not saying that you're publicly an aggressive allocator. Like, for example, I know a family office in New York that's invested in over 50 VC funds with a stated rationale of we want a lot of direct deal flow. Number three is publicize to the market, build a brand that you are focused on a specific industry and you add a lot of value in that industry, for example, real estate, and get to know all the VCs in the industry. Even if you're not an actual LP in those funds, they all know you might be an LP down the road, unless you say explicitly, I never ever invest in funds. And hopefully you, in fact, can deliver on the stated brand promise of adding value to those companies. And so they'll invite you into the rounds because they see you as adding value. Last strategy is publicize that you'll quickly co-invest in rounds. In other words, I've often had LPs say, oh, I want to co-invest. Then I call them and say, I've got a co-invest opportunity. And they say, great, give me a month to do my DD. That's not okay, right? Because then you're creating an extra burden of work for me, for the company, right? If the whole point is that you're outsourcing your DD and leadership to someone else, you have to trust them and move quickly. So there are a couple of firms like Correlation Ventures, which specialize in this strategy. Some of these players will share carry with the introducing VC because that way they get the first call. That also, you can imagine, is very motivational. And it's really important that you are light touch, easy to engage, because this deal dynamic, which by definition is evanescent of a live deal and a reputable lead, this will fade very quickly in the next 2 weeks, and you have to jump on it while it's still available.
David, that was excellent, by the way. For smaller family offices and independent investors looking to enter tier one VC deals, what's the best strategy of gaining access? Honestly, in some, I'm not even sure waiving 10 or 20 or 30 million, they could even get that opportunity, but you're the insider. What could I do? So the best way to do it is if you yourself are an industry insider, right? So for example, you made your money in tech, right? Then you're already connected in a sort of circles of people who know about deals. The VC industry is very aware of recency bias, meaning that people think of people more recently, that more top of mind if they've engaged with you recently. That's why there's so many events and people do podcasts and whatnot, because they want to remind people, I'm doing deals, I've got a checkbook, right? Here's my investment mandate. So if you're in that situation, you want to advertise to the market aggressively that this is your strategy, you're looking for live deals. But I really, really dislike the model of being a generalist when you're such a small dollar amount, right? Because whenever you see an investment opportunity, you should ask yourself, why me? Why did I get this deal, right? If a guy like me gets an investment opportunity in, I don't know, apparel tech, I don't know anything about apparel. My wife will certainly attest to that, right? So they pitched a bunch of other people actually know apparel. The smart people said no. So they come to the dumb people like me, right? And maybe I'll invest, but I probably shouldn't because I don't know anything about apparel tech. Yes, I mean, there's a little bit of a saying that I've heard in the community. I mean, I was probably a little bit of trouble here, but there are some people in that aspect of entrepreneurship, of raising capital, that sometimes, I'm not saying I do, of course, I'm too smart for this. They do, as you just kind of hinted, they sometimes feel that where is the dumb money at? And comparative to VCs and institutional investors, with a lack of rigor and structures and professionalism in some single family offices, unfortunately, they might be that sucker in the room.
Yes.
How do they avoid that?
So the related joke I've heard, if you look around the poker table and you don't know who the patsy is, you're the patsy. I would say that you want to understand the incentives of all the people, right? So there's a clear dynamic in the family office world of people wanting to invest directly, typically paying fees on an SPV. And the reason why people do this is they want more control, right? They want to be able to choose the deal. But that means they're paying fees on a deal by deal basis, as opposed to if you invest in a fund, right? The fund managers only get paid carry net of all the losers. So the math here is very simple. VC has the highest dispersion of returns of any asset class, right? So if I, as a VC, invest in 10 companies, 9 are zeros, and one of them is a home run, right? I may earn no carry, right? Because I have 9 losers. I don't deserve carry. But if you invest in 10 SPVs, right, you could end up paying a huge amount of carry on the winner. You lost all your money on the 9 losers. So you're much, much worse off than in the scenario of investing in the fund. So I would urge people to think carefully about that math. Do you think you can pick better than the market as you invest into SPVs? I've had LPs say to me, look, call me with your deals were your highest conviction. And it's really, I cannot say a priori that I'm such a genius that I know in advance what the winners are, right? Any VC who's been around the block can tell you that some of the big winners earlier in their corporate history had near-death experiences. Like one of my big winners from my prior firm changed CEOs in a not smooth manner. There's a lot of co-founder fighting before they really hit escape velocity. And that's common. So you just have to allow for the fact, and that's why the fund model exists.
David, it's been, some would say, a trying times over the last couple of years for VC, partially due to a lack of IPOs, a lack of exits, a variety of other challenges. And yes, we may look back at the incredible days of David Swenson and VC making up a third of the portfolio and getting even net of fees, mid to upper 20+% returns. Those days appear to be gone. That doesn't mean that they won't come back. It doesn't mean that pendulums don't shift, but it's not been a great couple of years. I can make the argument that I could invest in the Triple Q, the Mag 7, all very easily, be liquid, know what I own, have incredible returns if I just go by the math, definitely short term, but even over 10, 15 years. And why do I need to invest in VC where the exits are taking longer and longer for me to liquidate my interest? Now we could get into secondaries that may change that dynamic somewhat. And the returns net of fees just don't appear unless you're getting into the top tier. But like we discussed, even waiving a $20 million check, you just may not be able to. How is the VC industry going to adapt, innovate? Is it going to be AI? Is it going to be a new era coming in now with the new president? What are they going to do to address the issue that it's not been a good 4 to 5 years?
So VC is, and probably always will be, a cyclical industry, right? Going back to the very early days of the VC industry. And so we're coming out of a down cycle. I can't predict exactly how long it will be, but it certainly feels like we're on the upswing. And so I think this is a great time to, the people who have capital and are judicious about deploying it will do just fine, right? Because the market is, I think, more favorable than it was a few years ago in the 2021 peak bubble period. There are certainly some localized bubbles, right? Like AI startups are obviously, I mean, everything's an AI startup now, but certain categories of AI startups are obviously very highly valued, and lots of money flowing into those certain defined sectors. So I think that's just the nature of the industry. You just have to plan for it. To your question of why should you invest in VC when you can get relatively predictable returns from real estate, from index funds and so on. So I would say, first off, I agree with you. You only want to invest in firms that are top quartile and have likelihood of staying top quartile, or emerging managers, which look like they are going to be top quartile, right? Selection is far more important in VC than it is in other asset classes that have smaller dispersion of returns. So how do you identify those top performing managers? Certainly, there's a lot of research showing that emerging managers tend to outperform, but emerging managers, no surprise, tend to have less clearly attributable track records than the vintage four of an established firm. So that's part of why I'm doing what I'm doing. Is we are very excited about the emerging manager opportunity. We think those are going to be the next generation of elite performers. And the whole game of VC is to invest in or invest alongside that top decile tier of performers. What are the markers of those top decile performers? So at a high level, the way I think about it is PEAS. That's an acronym. It stands for people, right? Are the people credentialed? Do they get training in the right organizations? Do they understand that being a VC does not mean being a cowboy? You are now CEO of an asset management firm with legal obligations. E is execution, right? Do you understand that you have operational responsibilities in deploying capital? Just like that ball bearing manufacturer in Wisconsin, right? You are running an asset management firm. You got to think about the processes there. A is alignment. Have you put in significant personal capital into the fund? And last is S, strategy. Do you have a strategy that reflects the new world we're in? So, for example, right now, one of my number one heuristics for any deal or fund is, are they future-proofed against AI, right? AI is changing the way a lot of industries operate, the way the culture operates. And I would be very nervous about investing in certain categories where I feel like the AI is fundamentally changing dynamics. So, for example, a few years ago, there's a whole wave of VCs specializing in content plays. Like there are certain firms that would back emerging influencers, right? Mm-hmm. And that model could become challenging, where there are going to be more and more AI influencers who are going to be better than the humans, dance better than the humans, right? More attractive figures than the humans. How can you compete? And they produce content 24/7.
Yeah, wow. There's some directions I could go with that one, but we'll keep it a little PG. But maybe you all could put on your thinking cap and understand that there's certain dynamics in certain industries that are massive industries now. That whole dynamic that you described is going to be changing right before our eyes. But I'll have to do a different program on that. I'm going to go back a little bit. I promised I would bounce around a little bit to kind of family offices and technology. You introduced me to a wonderful gentleman, Dr. Ian Cook. I had him on my program yesterday. It's up as a current, if you go to my @Family Office audience, I highly recommend it. Honestly, it was probably one of my favorite interviews in the last 2 or 3 months, Ian Cook. It was my last one from just yesterday here in, I don't even know the date. I don't know, 21st, 22nd here in January, to give you some context. What I'm going to bring up to you would have been practically laughable 2 to 5 years ago, would have cost a massive amount of money. So that question is, how do you balance adopting off-the-shelf software and technology solutions versus now the consideration of potentially customizing and building your own? And we could get into AI agents, open source foundational platforms like Meta's Llama that allows us to control and not share what we're doing by helping to train it for the world and your competitors. Now it's not an insurmountable fee. It's not cheap, but it's not necessarily an insurmountable fee using current technologies that are getting literally better by the second to consider creating your own program that you have control, privacy, and customization for you. And maybe a follow-up to that, what does that mean to the more commercial programs, and what's going to be their viability in the years to come?
I think I have seen a dynamic where families have a bias towards building their own solution because they want the control. They don't want their data sitting in the cloud where other people can view it. But it does make me nervous, right? Most families are not qualified to build a new software tool. And the vendor, by definition, right, they work with dozens of clients. They understand best practices across their sector. They're professionals in doing it. So I think you have to be at a very significant level of scale before you decide to build a solution in-house. In the corporate world, Goldman Sachs and Google, I know from insiders, they have a strong bias to build their own solutions in-house, right? They have their own versions internally of things that most companies in the world use major SaaS vendors for. But they're Google and Goldman Sachs. These are huge companies, right, with unlimited budgets and lots of expertise. You do not have probably that level of resources.
Okay, I'm going to push back to you just a little bit. In theory, you're not incorrect. And it's good to have conversations where we could go back and forth. Again, I recommend listen to my Ian Cook or watch it from yesterday up on my @Family Office and @Family Office TV. AI has made this easier than ever. Some of the organizations that David mentioned, I'm not saying they're not wonderful and creative and have incredible talent. Obviously, they do. What do they also have? Hierarchy and bureaucracy. They're relatively slow moving. Did you hear, speaking of Google, Eric Schmidt's talk at Stanford that basically got taken down, but some people, and I'm going to reference him in another quote shortly, still have up there that you could probably find on YouTube. I think the world is changing. You don't need millions of dollars anymore. I mean, you might, depending on what you're looking to build. Are you going to make a commercial? What you're going to onboard, machine learning specialist, computer scientist, AI data scientist, et cetera, et cetera, et cetera. You may not need that anymore. Someone actually had the gall, Rick, I'm talking to you in a good way, to, in the chat yesterday, noted, basically, give me and another person like me, he said, he's an MIT grad, give us a weekend with a lot of caffeine and a lot of Skittles, and you'll be surprised if you give us the parameters and give us access to what we need, what we could come up with. Was it a little bit of a grandiose comment? Sure. But is there a grain of truth to it? Yes. So I do think if I was an existing provider, I would be a little afraid. How good are they going to adapt to AI? What's the competition going to be? But maybe that does lead me into my next question, David. And I'm going to kind of bring up Eric Schmidt again. And that relates to, do you believe that AI startups, and really let's go with all companies, could they have defensible moats? Or is the pace of innovation so fast that longer term dominance is going to be complex? And that does bring up Eric Schmidt in that same video, that off the grid video that still is up there in certain platforms, talks about you can now use AI to basically build, I think his example was kind of a replica of TikTok in a couple of hours. Now, how are you going to get the network effects and scale? Let's leave that really important part to the side for the moment. But really, defensible moats, I think that's going to be harder and harder. And that does make it interesting. But the audience wants to hear your opinion.
So first off, I agree that the speed with which you can develop software has gone up dramatically. A small team can do an enormous amount. However, and I should add, that creates pricing pressure for the major SaaS vendors, right?
Yes.
But from your point of view as a client, do you trust the two random MIT grads to build something that's scalable, that reflects industry norms and best practices? I would be a little nervous for anything that's mission critical, right? I would much rather call up a major vendor, say, listen, guys, I want to use your product, but you're too expensive. I could clone you in a weekend, right? Give me a price break, and then get something that's already working, right? So there's still, when I talk with my portfolio executives who are actively, aggressively using modern AI tools, they say, yeah, they're more efficient, but they're not cutting their headcount by 90%, right? It just allows them to be 25%, 50% more efficient, which is great, right? That's definitely very meaningful. But there's still bug testing, there's still edge cases, there's still issues. And part of what you're paying for from an established vendor is someone who has addressed all of that being the alpha client for a vendor with a user base of one, right? Where you are now dependent on the 22-year-old who you hired to go build this in a weekend, who could leave you for a job elsewhere anytime, makes me nervous.
Again, you bring up all good points, and it's good to have these conversations. Sadly, unfortunately, most people in my role in the family office world, they're just so ignorant to it relative to AI and technologies. It's a little sad. And Parth, in the comments, I believe, on YouTube, which I'm doing live, I'm going to address your comments in a couple of more minutes that will relate to that. Yeah, there's several different directions I could go there. I admit I'm an extreme control freak, extreme. And if I was even richer, I'd probably be even more of a control freak. And then you add in privacy and customization and how things are rapidly changing. And I don't trust a lot of legacy platforms for me. And these are all things, oh boy, this is going to be a queue up now, David. If you're listening to this live or hear it in the next couple of days, I will be leaving the frigid cold, going to Miami. I'm speaking effectively from the 27th through the 29th at Uncorrelated Miami or Uncorrelated Alts Miami. I'm leading a breakout. I'll be there. I'll be doing a couple of meetings. And my breakouts for family offices are going to be talking about being built in a pre-AI world, about sovereign risk and liquidity, which is really directly in my wheelhouse. And I'm going to give the story of April 6th of 2024, not even a year ago, how New York City was literally rocked and how things closed down for about 30 minutes and what would have happened if that was worse. So it's going to be incredible. If you're a family or family office, DM me, text me at 203-570-2898. Email me if you'd like to attend, if you're going to be in the area. I have a lot more in-person appearances at various programs and some that are my own program, like my Palm Beach single family office event in March. So stay tuned. 2025 will be a very, very active year and not all digital. I promise I'm not AI. I think I'm a real person. If I was AI, like David said earlier, I would have made myself better looking. So this is, hopefully you're not going to be disappointed in person. David, how should family offices consider launching their own venture studio, bringing the talent in internally, sourcing deals, and becoming a controlling direct investor?
So I know some families that have done that. It is very much a niche strategy, right? If you're Kevin Ryan, well-known New York investor and entrepreneur, sure, do it, right? Like, he has the credibility, very successful founder, good for him. Again, most families don't have that DNA. That's not what they're good at. So it's chutzpah for them to, if they made their money in real estate development, to suddenly think, okay, now I'm going to launch my own studio. Now, you can hire people who are qualified, give them appropriate economics to go build a studio, and maybe with a focus on prop tech. Great, that's a legit model. But again, just because you made money in one sector doesn't mean make you genius who can make money in lots of other sectors, right? You could also educate yourself and transition yourself into being someone who understands how to build software companies, but you have to budget for some time to do that, and you can waste a lot of money if you spend tuition in the form of investment dollars into startups that have low probability of success. So I am very focused when I advise investors and families on figuring out your comparative advantage. What are you good at? And outsourcing or figuring out ways to use standard practices for things that are not your comparative advantage, right? Because I believe in not being creative in everything, right? You should be creative and innovative in the areas where you understand what you're doing. Never else do what the rest of the world does. I know that sort of sounds like I'm saying just follow conventional thinking, but the conventional thinking, there's usually a reason why it's standard. I think you can burn a lot of cycles trying to reinvent the wheel instead of focusing on what you're good at.
I mean, I think there's liquid opportunities to get VC-like returns currently. You look at things like space, like drones, robotics, obviously AI, incredibly volatile at the smaller public company markets, but some returns I'm almost embarrassed to mention here on screen. Go back and watch some of my relatively recent interviews with JJ Sowers. And in November, I had Ralph First, former World Series of Poker champion, who's VC and early investor. We spoke a little bit about venture studios. Given that I am a control kind of guy, I'm leaning towards, depending on the family, being an advocate in terms of having your own quote unquote venture studio. But again, perhaps a discussion for a different time. David, I guess the question every family wants to know, as if this one's going to be so easy, David, looks like we may be going a little in and out. How do you identify asymmetric opportunities, meaning those with the perfect profile, low downside and risk with massive upside potential?
So my camera, for some reason, has gone fuzzy. So I was trying to adjust it, but I'll just continue. First off, I'm looking to do that. I think you need to think like a value investor, not a momentum investor, right? So look for investments that are reasonably priced. Those tend to be somewhat off the run. The VC industry is very pattern biased. In other words, very biased towards investment opportunities that look like central casting. So founded by a dropout from a top tier school, technical founder in the Bay Area, New York, right? If that's the profile, that tends to correlate with a higher valuation. And some of those companies do great. I'm an investor in a bunch of companies that look like that. But as soon as you're not out of central casting, you're coming out of Atlanta, you're in an area that's not top of mind technologically, then to give you a high valuation, and it's more likely that you have the downside protection coming in at a reasonable number. So I like it when other VCs are not excited about the sector or the company, because that means I am correct but non-consensus. And the best investment returns come when you're correct but non-consensus. I also like what I call dual PhD investments. That means investments that are at the intersection of two different technical domains. If you look at the discipline of scientific history, right? People who study how science develops, how innovation happens. One of the consistent patterns is innovation happens at the intersection of different disciplines. So for example, people understand computer science and biology, right? Those are the people who are playing in the world of using AI and ML to identify new tools in biology. And that's a great growth area. Bill Gates has said if he were a young person, he would be into biology, because he thinks that's a huge growth area. And so there are, certainly I'm not the only person interested in this area, but I find that these tend to deter some investors because they don't understand one or both of the PhD areas. But if I can put together a syndicate of people who understand both of the disciplines and understand what's happening at the intersection, that increases the odds that I'm onto something that really is new, where I can get some significant returns and protect my downside by coming in at a reasonable valuation.
For a percentage of a family office's portfolio, David, think of it, maybe I'll use a baseball analogy. In one swing, I could strike out and its next batter up. Or best case scenario, the bases are loaded, my one swing scores 4 runs. But it's somewhat of a limited upside. In the world of VC, I could lose, or earlier stage investing, etc. I could lose what I put in, but I may have practically unlimited upside, much more than a 4-bagger. Now that is way harder than it looks, but the appeal of that potential, including to investors like me, sometimes is very hard to resist. How do we know how to have discipline and how to structure an internal, even if we don't have a formal VC studio, a portfolio that allows us the potential for maybe 10% of our allocation to get that unlimited upside?
I think all of VC investments, I believe, have that potential of unlimited upside. So I think it's inherent to the discipline. That's assuming that the security is structured in some standard way. So according to many news reports, the initial Microsoft investment in OpenAI had effectively a cap of 100x, which is a pretty high cap.
Yeah.
But anyway, that did have limited upside, although I suspect they were fine with 100x. So I think I'm more concerned about protecting my downside, given I know there's always a significant probability that it'll go to zero.
What are some common myths, I would even say lies, that VCs perpetuate about deal making, value creation, exits, etc.?
Yeah. So the number one myth or misunderstanding people have is why people are deploying capital. They think it's for returns. So if you had asked me 15 years ago when I became a VC, why do people put money into startups? Why do they put money into funds, VC funds? I would have said alpha, duh, right? You're trying to grow the money. That's actually the wrong answer. So I published formal research on this in Institutional Investor on what are the jobs to be done of an investor. It is much more than just alpha. It also is don't lose money. It is match your liabilities. It is to protect against tail risks. It is to gain knowledge about a space. And different investors will invest for some different combination of those reasons. And a dynamic you certainly see in VC is people invest in deal because they want the logo on their website. They want to say they're co-investing with Elon Musk, especially now that Elon Musk has become more powerful. They have some other angle, and it may be that they're investing for that angle, not for return. So if your interest is financial returns, you don't care about that other stuff, but you're co-investing with people who are doing it for other reasons, that can be a problem, right? Because you're getting the wrong signal from the market about why a specific deal is attractive to them.
Interesting. What sectors, we're going to maybe a little bit of a segue into fintech. What sectors, and I'm going to maybe define fintech as payments, lending, wealth management, reg tech, insure tech, etc. Again, what sectors within fintech offer the most attractive investment opportunities within the next 5 years?
So I am particularly bullish on what I call investment tech, which I define as tools that help investors generate alpha. I run a blog and community called pevctech.com, focused on this space. The richest person in New York, Mike Bloomberg, he didn't make money as an investor. He made money selling picks and shovels to all the other investors, right?
Yeah.
So he has recurring revenues, whereas the other investors, if they have a couple bad quarters, they can be out of business. And so I prefer Bloomberg's model. So I have invested in a number of companies in the space, Adapar, for example, which is back office for family offices and RIAs, Earnest Analytics, it's an alt data company, firms like that. And so I see a lot of opportunity there, and it's a double benefit because that is an economic benefit, right? The company will hopefully grow and generate real value, but also you as a investor, you can be a client of some of these companies and you can generate operational alpha, right? You can run your operation more effectively by using these modern tools. So that's an area I'm excited about. You mentioned reg tech, technology to help people stay compliant. So in general, I'm bullish on it. I think in this new political environment, I suspect you'll see some reduced spending on compliance because the new administration generally is trying to be hands off. But longer run, there's certainly a tremendous amount of manual processes in compliance and lots of room to do it better. Like just to tell you one of my favorite statistics. So I read an estimate that the cost of complying with US tax law is about 1/3 the amount of money that the IRS collects.
Yeah.
Right?
Yes.
That's staggering, right? Staggeringly inefficient. The amount of money that corporate America has to pay for all its endless accountants and tax lawyers and so on. And it's not beneficial to the country, right? To have all that money go to all those people instead of going to the IRS or staying in the corporate coffers to go for other purposes.
No, very good points. A couple of texts came in since you all may be interested. Basically challenging a little bit of my assumption of keeping more things internal unless you're a multi-billion-dollar family office with a lot of people. I think that's partially baloney. I think dynamics are changing relative to technology, systems, standard operating procedures, and there's no reason why that you may not have a leaner staff, even in a multi-billion-dollar family office that's an active, not even a quiet and only on family legacy. No one of my Angeloisms, no one cares about your money like you do. And that is one of my basic tenements about privacy control and customization in a family office. Another interview, it's a little dated from last summer, and David knows him as well, and he's a wonderful man, Jamie McLaughlin. We had a debate, I guess I would call it. I would do some things differently in that now because we all evolve after 7 or 8 months and learn more. But I'm a big advocate of you should take control. No one cares about your money more than you. If you have the resources for a family office, you should do it right. And you should do more things than less things, in my perspective, internally. You also mentioned, how come I hate upon GP structures so much? Not true. I think 5% of them are pretty awesome. Now, is that meant to be tongue in cheek? Because that means, do I think 95% are not? Probably 10 or 15% are good, but I want to hold that to a higher standard. And again, I like control. I like customization. I like interaction. I want to roll up my sleeves. I want to be responsible for the failure and the success, not someone else. So for me, and yes, I am an LP in some interest, not much. I've lightened up, and I am way more active direct now. But I do think if you were to say, Angelo, could you get into Andreessen Horowitz or others? I can't. And if I could, depending on my scale and a variety of other issues, fiduciary responsibility to family members, etc., I would. Yes. So I do think that sometimes being an LP for part of your portfolio is wonderful and a good move to take. David, I don't know if you have any general comments on my comments. Whenever I give my text number on these lives, I get some interesting text.
I would say that the nature of a public conversation like this is we're both speaking generalizations. In any live situation, it's always dependent on the idiosyncrasies of that investment and your particular mandate.
Yeah, I mean, I know that at that uncorrelated Miami, the main program is going to have about 400 people. About 20% of them may be buy-side investors and family offices attending my breakout, of course. And I'm going to hear from the others, oh, you're that guy. You're the one who talks a little bit of shit relative to GP structures. Again, I think 5% of them are just flat out awesome. You just have to identify, and if you could get in, and what percentage of your portfolio. I'm not dumping on the industry. Yeah, I may be saying that with a little bit of tongue in cheek, but no, seriously, 5% are really good. How do you assess, staying on fintech, whether a fintech startup is really disruptive or really just a more efficient version of an existing solution?
Yeah, so people tend to use disruptive in a colloquial sense, but yeah. I think of it in the technical sense using Professor Clay Christensen's definition. Mm-hmm. So popularized in his book, The Innovator's Dilemma. So one way of assessing it is this innovation something that one of the major industry incumbents could do, right? Is it what he calls an iterative improvement, or is it truly disruptive? Something that is disruptive is something the major players couldn't do because it so changes their economics or destroys their economics. So a classic example in the world of asset management is Vanguard, right? When Vanguard launched, they were selling mediocrity to low price. And they were mocked by the established players who were in the business of selling a promise of alpha at a high price, right? So they would never sell an index fund, right? Because they'd be destroying their margins and it would be totally off brand for them. So Vanguard took quite a few years to validate that this model made sense. And then Vanguard grew explosively and indexing grew explosively and absolutely is a threat. A friend of mine at one of the top 10 mutual fund companies said, look, we have a melting ice cube here, right? We know that indexing is steadily eating away at our core business. And we're just trying to, make money while we still can before the business goes away. He's probably exaggerating a bit. Like we obviously need active managers for indexing to actually work. But his point has validity to it. So that's a hardcore technical test. I also want to understand on a practical level, are they uniquely qualified to do this, right? Are they the classic dynamic that Christensen found in his research is disruptive companies will do one job well and they'll do a lot of other jobs badly or not at all. So I mentioned earlier my research on the jobs to be done of investment managers. I'll put a link in the chat to that research. So if you look at some of the disruptive companies that identified in that research, so for example, Earnest Analytics, that's a company I'm an investor in. They take alternative data and they mine it and package it and make it usable and clean and sell it to hedge funds and corporates and others. So in the broadest possible sense, they're competing with traditional research vendors like a Goldman Sachs research note, but it's really a very, very different product, right? They're not claiming to have built the best financial model for IBM and have the best understanding of IBM's earnings drivers, right? That's not really what they're doing. They're saying they have the best data about sales of IBM services, and that can give you insight into IBM's next quarter earnings, right? So they're doing a bad job, you could say, of selling traditional research, but that's totally okay. And Earnest is doing great, right? Because they're selling alternative data, which is a subset of the traditional research product. But collectively, alternative data is one of the two fastest growing sectors in the investment research business, the other being expert networks, and is over time eating some of the lunch of the traditional research product.
And again, this would be for the live audience, because this one, you don't even have to Monday the 27th when I'll be in Miami at Uncorrelated. I will be heading into New York a little bit later today, and I'm going to give a shout out again to David. David has introduced me to some really incredible people in the last week or two. He's very connected. As we get to the end of our conversation in about half hour, I'll definitely give opportunities where you could learn how to reach out to David. I highly encourage it. And David, in case you're wondering what it is, it's our friend Francois, who I never met, but I've been talking to for a long, long time and a great fan of his work, and a tech entrepreneur in the family office world who I've known for years, a young gentleman named Dean. They're doing something, well, maybe I shouldn't say, but it's Classic Car Club. I'm a big fan of that. We'll be heading into New York. And maybe if there's a single family office around that wants to reach out to me and wasn't crapping on me in some of your text about how I'm, Mr. SFO advocate here, and maybe my audience that knows me may be heading to the Carnegie Club for a nice cigar a little bit later tonight before heading back to my rural location in Connecticut before I go to Miami, then to Wyoming. So it's going to be a pretty crazy next couple of days and weeks for me. David, staying a little bit on that theme, apparently I'm on a fintech theme now. What are some of the key risks to watch when investing in fintech, particularly given, although this may be adapting with the president, but regulatory scrutiny?
Well, in the new administration, it's the biggest risk factors if you've hit one of the hot buttons of this administration, right? So for example, if you were selling technology for facilitating DEI initiatives, you have a problem, right? Because clearly the dynamics around the sector change.
You would have a problem.
So it's a very different heuristic than the way investors usually think about these things, right? Usually you don't think about hot buttons, you think about business risk, or like, is your business at risk of being a Ponzi and exploiting retail investors? Now you don't really have to worry about that so much because the administration doesn't care as much about those issues. I would say that this is one of those questions that it's hard to answer in the abstract. Every company has its risks, and part of my job is to think about how to mitigate those risks. I think in fintech in particular, one issue I think a lot is about misuse, right? I think in technology, every new successful product will be misused by criminals, bad actors, you name it, right? And so you have to prepare for that. PayPal, Peter Thiel said that their core asset over time was not the ability to transfer money per se. It was that they figured out how to combat all the many, many criminals who were using PayPal in various illegal ways in their early days, right? That was a very difficult problem, and it's still a difficult problem, but PayPal has figured out automated solutions to address the fraudulent use of it. Similarly, a lot of crypto-related products, one of the use cases is for various forms of illegal activity. And so if you're investing in a company space, you have to think about to what extent is that going to be a risk where you could be implicated, could create problems for both your firm and for other users in the system if your product is being used for money laundering or other things.
Yeah, I mean, you don't throw out the baby with the bathwater. Lots of things I could say about that. Boy, that was some interesting commentary you have. Mild-mannered David there. You almost led me down some roads that would get me even in a little bit of more trouble. My audience knows I'm pretty opinionated on geopolitical, political, and areas. And why don't I say this? I'm an extreme advocate, and bring on the hate, audience, of meritocracy. Meritocracy. May the best person, no matter who they are, what they look like, win. And yes, I will be having, I'll call it kind of a debate coming up on that mid-February with someone I do respect, and maybe I could learn something from. So we'll find out. I definitely go down roads others don't go down in the family office world, but I'm really enjoying it. David, I'm going to switch over a little bit. Maybe some would describe it as fund management. What's the biggest mistake you see new VCs, angel investors making, and how could they avoid it?
So I will quote David Rose, well-known New York angel, said the worst thing that can happen to an angel is to have a huge win earlier in their career, because then they think they're a genius. So that is definitely
that's great.
that's definitely a problem some people have. Another mistake that people have is not appropriately future-proofing, right? So I mentioned earlier the concept of how is AI going to impact industries, impact social norms, and so that's a bigger and bigger issue, right? We talked about how for every product you have to think, what will bad actors do with it? Now we have an even bigger issue, which is automated human seeming bad actors, right? So in general, in consumer-facing internet technologies, there's a trend towards a price point of zero, right? So like 30 years ago, you would have paid a lot of money to do what Google.com allows you to do for free, right? So Google built a business where they could sell for zero this incredibly valuable tool that allows you to research all the knowledge in the world. Good for them, right? It's created a lot of consumer surplus. So what's the big business model that's emerging? AI avatars and fake, AI people. And the business model that I think is going to be the winner is they're for free. You can get your AI girlfriend, AI therapist, AI lover, right, with video, and they'll talk with you 24/7 for free. How do you monetize? They're going to upsell you. They're going to say, hey, you should buy this crypto product. You should sign up for this weight loss drug. Or by the way, you should vote for this candidate. And because it's your trusted partner, right, you're going to listen to them. So I think that's a social problem that is definitely concerns me. But those AI avatars are also going to be signing up for all sorts of new businesses, and you as investors should be thinking about, how do I mitigate the risk of these fake people? Are going to be harder and harder to disambiguate from real people.
100%. We almost went down the road 20 minutes ago, but since you keep on bringing up interesting, some would say slightly controversial subjects, I'll slightly jump into it, then we'll move on to the next question. OnlyFans is an incredibly profitable enterprise. I believe off the top of my head, more profitable than the NFL. This is shocking. And by the way, in my perspective, wickedly sad. That will be upended by avatars and AI in ways that I think are very obvious. And that's an example of an industry and a revenue stream, especially for the top, maybe 1/100th to 1%, that I think is going to be gravely challenged. There'll be a whole new dynamic moving forward. We are heading into interesting times. I didn't necessarily use the word good or bad. I said interesting. It's an interesting time to be alive. What recommendations for those that may be listening as entrepreneurs, as newer managers, what recommendations would you have for new managers when it comes to raising capital from family offices?
So first off, this is an issue that comes up all the time in Coolwater Capital, because we work with many different emerging managers. So I would first figure out, what are you selling that is differentiated? If you are selling, I'm an investment management firm and I believe I'm going to generate healthy returns, that's a very crowded sales pitch, because literally every other investment manager on the planet has some version of the pitch, right? Like, I will make money for you, give me money and I will grow it. So you need to figure out some stronger pitch, like, for example, I'm an investor in Fintech and I will help you to be more effective in your financial services business because I'll give you knowledge of new vendors and help you generate operational alpha by exposing you to innovation in the space. Or I will, we run an annual general meeting for our limited partners who are a really interesting group of people. You go to that AGM. That's a promise that you can deliver on that is differentiated. And it is idiosyncratic to your particular firm, strategy, ecosystem, what you're offering. So even if, like, I know a hedge fund that legitimately has strong historic returns, has I think a differentiated model, and they have lots of challenges in raising money, right? Because it's hard to raise money. It's the hardest product to sell, right? And so you need to figure out other ways to get people to pay attention to you, to open your email and give you the time of day so they can actually seriously assess giving you money. Another common dynamic that I see is people who are not thinking thoroughly about the opportunity cost of launching investment management firm. Lots of people want to run their own investment management firm. I get it, right? Like, I resonate with that. But there are real costs to doing that in your foregone costs. Typically, the person who launches a new VC fund, for example, they were a successful exited founder, they were a non-founding partner at a VC fund, right? So the opportunity cost of their time is quite significant. And now they're earning $0 or something way below market for what could be quite a few years. So I would urge people to think about that really carefully before they take the jump into being an entrepreneur with all the concomitant risks.
And I don't think we could have the discussion that we're having without me bringing up this question. And it has changed, some would say positively, some of the impact of investing in VC, and that would be privates, et cetera, to a degree. What role do you believe secondary markets and liquidity solutions will play in the current and future of venture investing?
So I think that the line between private and public is getting fuzzier, right? Because there are now more and more ways to get a chunk of a private company. The public markets are much more regulated for good reason, right? Like, we want to protect the market, the ecosystem from bad actors. And that is in the long-term interest of the players. Like, everyone is annoyed about compliance cost, I get that. But one of the reasons why people all over the world put money into US public markets is precisely because it is regulated in a transparent, neutral way. And that gives people comfort that the 10K is not full of lies, and that they can trust that everything is being done in a kosher manner. So in the private markets, there's more room for bad actors, which you need to protect yourself against. And there's also a lot of, because it is a more illiquid market, fewer trades occurring, right? There's a lot more room for difference in prices between, say, different exchanges or different trades that are happening. So that's an arbitrage opportunity, which the smart investor is taking advantage of. Long term, one of the weirdnesses of our industry is in just about every other asset class on the planet, almost all the activity is on the secondary market, right? When you buy stock in the public market, that's a secondary purchase. It's almost never that you're buying stock at the IPO in the first issuance, right? That's probably, 0.2% of all the trading activity is such offerings. But in our world, most of the activity is primary, right? They're issuing new stock. So I foresee over time, our industry will look more like the public markets, where more of the trading activity is secondary.
And David, I guess it's been a bit of a trendy topic also with the new regime coming in, and I think it'll be a positive change. Now, yes, some would say an extreme capitalist and libertarian, and I think overregulation is absolutely bad. And to protect non-accredited investors from themselves is, to me, it's just woefully arrogant to believe that. And it does limit opportunities that quote unquote accredited investors currently as defined could get into opportunities that I can't, because you need to protect quote unquote me, that person in that example. henceforth, it looks like the definition of accredited investor, qualifying not as much now potentially on assets, but on effectively passing a test. Let's go with that. Do you broadly look at that as being a good thing or negative? And it's okay to disagree with me. Most people do. But how do you think that's going to play out? And is that good or bad?
I'd say we are grossly inconsistent. Like anyone in the world, no matter how poor, can go into a casino and blow their money at the craps table, right? And we allow that, right? We're giving people autonomy. There are some controls, right? So you can, you can call a gambler hotline and ask to basically be blocked from the casinos, if I recall correctly, the way that works. You're basically protecting yourself from yourself. But the point is that we allow people to do all sorts of stupid things, right? Drive cars at high speeds with no seatbelt on and whatever. And so I totally get your point. I do think that there's absolutely a need for regulation in, for example, your financial reporting, right? To make sure people are not lying. And there should be penalties for lying. And if you don't have penalties, people will lie even more than they already do. And that's a really bad thing, right? In America, people don't realize this in America unless you do business in other countries. We're a pretty high trust economy, right? People will trust that your financials are accurate. You're doing what you say you're doing, right? And they'll do deals with you. And in many countries in the world, people are very hesitant to acquire your business or do a deal because they just don't know what's real.
Yes, 100%. And a little bit of a break for a second. Those of you that are enjoying the conversation and are not a subscriber on my LinkedIn or at Family Office or Family Office TV, both on YouTube, go ahead and do so. I think I do some very intriguing, pushing the boundaries content, at least by Family Office standards. You could also go to angelorobles.com. I have decades in the industry. I'd like to think I'm a free and creative thinker. Wrong, sure, I have my fair share, but I definitely am different than what is classic, traditional, or if you want to use the word I used earlier, legacy. Take a look at my homepage, read it, think, join my SFO continuity. That's my membership group, and get really exclusive content, access, invites to what I'm attending today that I mentioned in New York, my programs next week in Miami, my big, really private program in Palm Beach, all I'm doing in New York, a little bit of Jackson Hole, a little bit later in the year, and a lot of really deep proprietary content and connecting the dots, especially from future forward and a technological perspective. And again, my love of addressing sovereign risk and all the challenges that are out there, liquidity. I have some very unique and strong opinions about that. Nonetheless, you know where to go. David, what do you find most disruptive in the industry now, and perhaps going down AI and the path of jobs being diverted, different, limited? If that's the direction you want, we could go down that road, but I'll leave it up to you.
So I think that our industry is inevitably going to be more diverse. The baby boomers, they're dying off, right? Who are the inheritors? The widows, right? Generically speaking, of the mainly male wealth creators. And America is getting more diverse. We're a majority minority country by 2040, right? It is physically impossible for the administration to deport enough people to stop that train from rolling. So I think that a lot of our industry is not fully sensitive to the fact that this client base is going to look different, act different, have different values than the clients they're used to, and they need to take that into account. So there's a reason that hardcore capitalists like BlackRock and Goldman Sachs and so on, they've made efforts to try and build bridges into the Latino community and African American community and so on, because Goldman Sachs has a whole initiative around women in business because they know, right, those communities are growing in importance. They control a lot of wealth. They're important, right? And if they don't speak their language and make them feel welcome, they're not going to do business with Goldman, right? So I think our whole industry is not fully acknowledging that fact. It is a capitalist way of thinking. I'm a capitalist, right? To acknowledge that fact and design your business to address consumer needs.
No doubt about it. I think my audience knows I'm a very open book. I'm half Latino and very proud of it. And I think what you said is accurate. We do need to have more interest in people in the community that represent what's a changing demographic, I guess you could say, the American public in a variety of different ways. Now, again, I'm going to go back to me being a believer of free market systems, less regulation, meritocracy, may the best quote unquote person, no matter what, win. That leads to deeper discussion that we could have on more of a societal basis. Again, I got one or two of those coming up in February. I'm going to lean a little bit towards what I've been hinting at very strongly, and that's AI agents, technology. You understand that law firms, let's use them as an example, why do they need more associates? They have AI and AI agents now that are doing a lot of the work. It's saving the company money. The senior partners are making more, and potentially there's less problems with what I would loosely define as people problems, and maybe the most talented people getting plucked and going somewhere else after you put a couple of years into them with relatively little or no profitability. So dynamics of companies are changing. Basically, wealth management, professional services industries, and the family office industry, not in 10 years. That's obvious. Kind of right now, but especially more 6 months to 18 months from now, they're going to be able to do more faster with less. This is just a reality. Do you want me to sugarcoat it for you to make you feel better? I mean, I'm not going to do that. And no, this is not going to take 10 years to play out. It's already happening. It's going to accelerate more so likely heading into next year. And to ignore these realities, and that brings up other questions with college age kids and what are they going to do, and the dynamics and pressures on the country, universal base income, all subjects that I love, that we'll cover and have both sides for another time. David, what macroeconomic factors, rising interest rates, inflation, do you think will have the greatest impact broadly on, if you want to go broadly in America, investing in companies? Sure. If you wanted to narrow it down to the world of venture capital, fintech, either one is fine with me.
So on your point about AI and how it's changing staffing, so economists talk about the lump of labor fallacy, the idea that, oh, jobs are going to be destroyed because the machines come in and take away human jobs. But in reality, and I've had this conversation with my friends who work for major law firms, right? They always feel like there's so much work to be done, right? So they're using these tools to be more efficient, which justifies a higher billing rate. And then they go out in there and they win more clients. There is an argument that AI is actually going to increase demand for lawyers. Why? Because now if I'm doing a deal with someone, like a business deal with someone, right? Often I don't use a lawyer, right? Like if we're talking about a simple engagement, I have certain templates for certain deal structures that I use in my industry, and I use my off-the-shelf template. Like I know enough. I'm not a lawyer, but I know enough to draft it, and I'll sign it. And I don't worry because the amount of dollars involved is small enough. It's not worth it to me to go pay a lawyer. Now, imagine a world where I have a robot lawyer, right? So I use the robot lawyer, and what does he do with my 2-page simple NDA, right? Or my 2-page simple referral agreement? He takes it and adds in all the edge cases and all the bells and whistles and makes it 20 pages long. I send in my counterparty. He uses his robot lawyer to review it, and we have some back and forth, and we sign it. Great. And it's all super easy, right, in this robot lawyer universe. But now we have these long 20-page contracts, and at some point you need a human to review it, right? So you're actually creating more legal docs out there, and the AI is making the lawyers more efficient, but you still need lawyers to review them. It reminds me of the old joke about the lawyer who moves to a small Western town, and he's the only lawyer in town, and he has no business. A month goes by, another lawyer moves in, and suddenly they're both busy, right? Because they both have respective clients. So I'm actually not that worried about job destruction in many areas of our economy, because, and you see this in technology over and over and over again, right? It grows the pie, right? We are much, much wealthier as a country, as a globe, than we were 50 years ago, despite all these technologies that allegedly destroy jobs, right? Because the loom, right, and personal computers and word processors and all these cool technologies that allegedly destroy jobs have in fact made us wealthier, made us more productive, and new jobs have emerged to fill the old job of being like a hand copyist of scrolls, which was a job 200 years ago. So I think that's not a big concern. I do think all of us, white collar professionals, we're not going to be replaced by an AI. We're going to be replaced by someone who knows how to use AI tools. So it's certainly incumbent on all of us to learn how to use these tools to do our respective jobs as effectively as possible, increase our productivity, and avoid getting replaced by that savvier, AI savvy young person.
All good points, David. And again, I like the fact that we can maybe disagree and go a little back and forth. Audience, I hope you're enjoying it as well. Yes, you could be replaced by the person who is smart, a creative thinker, and is using AI to enhance their capability, their outputs, if you're not. But from my perspective, that will work for the next year, next 3 years, maybe even 5 years or a bit longer. Eventually, some of you, if not most of you, will be replaced just outright by AI. I know you all heard this before. This time is different. But yes, this time is different. I have a lot of content this year, in person and digital, coming out about this. More than happy to have multiple different perspectives. And I know the perspective I'm giving is not making you feel all warm and fuzzy, but I'm telling you as I see it, which I could very well be wrong. I'm actually almost always right, but my timelines could be off. So maybe you're saying, Angelo's probably right 20, 30 years from now. And no, I think I'm right, like relatively in the moderately foreseeable future. I hear you, David. I think those are fair points. And again, things that we could have an open and honest discussion on. I just think that's a little overly optimistic, especially as we address or get into more advances in LLMs and energy uses to enhance the capability of AI, getting into AGI, getting into superintelligence. And maybe that's 10 or 15 years off, not AGI, but superintelligence maybe. All interesting things. Maybe I could get Ray Kurzweil longer than 10 minutes this time to come back on and just not talk about his robotics company. So we shall see. How do you approach investing in markets that are still in their infancy, like quantum computing, biotech AI? What signals do you look for?
So I want to look for the people who know about that sector and follow their lead, right? Like figure out how I can add value to them. Maybe I'm a logical follow-on investor for a seed investor who specializes in quantum computing. And they'll appreciate someone who has knowledge of the broader capital markets and family office ecosystem. So that's key and I say this probably because I used to be CEO of an expert network business, identifying who really understands the space, both to educate myself, but also to figure out a way to empower them. So maybe I make them a venture scout, right? I share some economics with them to help source deals for me, and I can benefit from their being on the front lines of their discipline.
Interesting. What's a material mistake? And we all have them. I got a whole bunch of them. What's a material mistake that I'm going to pick on you now, David, you have made in investing, and what was the lesson learned?
Oh, so many mistakes. I have to think about what I can share on this forum. So I'm thinking about one investment where the company's doing pretty well, New York company, and at a certain point, the whole management team came to us and said to us, either you fire the CEO or we all quit. So because the CEO, in their opinion, was unprofessional, rude, not doing a good job. So we caucused with the other board members. This was a very easy decision, right, to fire the CEO. We had to get the other board members on board with that because we didn't have the power unilaterally because we were not a controlled shareholder. So we got alignment from the other shareholders. We fired the CEO and promoted one of the team. So this was a mistake because the CEO I'd say it's a very typical dynamic, right? You see this in tech over and over, right? Charismatic, strong-willed, big ego, thinks he knows exactly how to do things. And sure, it worked for Steve Jobs, it works for Elon Musk, but it also sometimes has bad outcomes, right? And so in this case, the company was going down a bad path because the CEO was not as smart as he thought he was. And the company has since gone to a much healthier path. So I was very grateful that we had made a point of building relationships with people below the CEO level So they felt they had some connectivity with us, so they could come to us with this information, because they'd much rather have them come to us with this report than just hear, oh, the whole management team quit, right? Because then the company would just die. CEO can't replace all of them in one fell swoop, typically.
Interesting. I might have two final questions. We're going to go a little longer than I thought. David, you're so enticing. Who cares about my New York appointment with Francois and others at the Classic New York Car Club, whatever it's called? I'll be there later. It's good enough. I'm going to bite the bait from a commentary via YouTube of a live participant, which really has very little to do with our conversation today, but I'll try to keep it 1 minute. Parth states, I am working with a business with the goal of improving every single family office consultant with the objective to attract or have higher multiple from family offices. I mean, I could care less about that. I want to provide value at a cost that is fair to me. And I hope the value the other party gets, I hope it's 100x, 1000x. I don't care. I don't pay attention to what others charge. I charge what I charge in my membership or my consultative relationships. And certain words like I am working with the business of the goal of improving every single family office consultant. One, there's not that many. Most of them don't want to improve. I'm obsessed with what I do. It probably is a little bit bordering on being unhealthy, but it's me. It's my persona. It's what I do 24/7 and what I love. So not everyone is going to have the capability, the capacity, the obsession, the interest, the willingness to admit when you're wrong, and go to my Jordy Vischer interview around between Christmas and New Year's. That guy is brilliant. And the work that we did on Bitcoin and AI, it's all up on my @Family Office. My members got it first, and I shared it more publicly. And he will be speaking, 99% sure, at my Palm Beach event in late March. And we talk about areas like that once people have something in their mind and they're outward with their opinion of it, getting them to change without putting in the work, and they don't want to put in the work, it's effectively impossible. They rather be right than make money. And by the way, they're not right on things like Bitcoin and other things that I could talk about. So I'm generally, I guess, an outsider in the community. I used to be the insider, but now I'm the outsider. I like to be that. I want to think for myself. I want to be a creative thinker. And I think those things are woefully lacking in the world of the family office community. There is a lot of groupthink, and there's a lot of things where let's have the same old people recycled over and over to sell their perspective of Wall Street or whatever it might be. And if that makes me an outsider in the community, then wow, I really want to be the outsider. So no legacy family office for me. David, a little bit back to technology, and we could get really deep into this. Let's give the 2-minute answer as we're getting close to wrapping up. What key components should a modern family office tech stack include to enhance efficiency and, to me, more important than that, decision making?
So just to make sure I understand the question, you're asking internally within a family office, what tools should they use to make sure that they're making thoughtful decisions and running.
Even if you don't want to be overly specific with company names, things like CRMs, aggregation reporting, what is a stack that would make some sense?
I think it'll be more efficient to take a look at my public analyses of some tech stacks. So if you go to my blog, I just put the link in the chat, evctech.com. I am the only person I know who is publicly sharing different tech stacks of different investment managers, single family houses, multifamily houses, hedge funds, private equity funds, VC funds. The reason I'm doing this is there are lots of vendors in this world. They all have case studies of how awesome their product is. They're all biased, right, for whatever their product is. So it's much more helpful to talk with your peers. What decisions have they made about the tools they're using to run their operation? So I started this initiative on my blog to make it easier for investors to benchmark against their neighbors, people who look like them, on the tools they're using to run their ship. So I suggest look there.
Excellent. And in reading some of your work, I like how you use verbiage, kind of good consultants verbiage, like KPI, key performance indicators. I don't think enough family offices are quantifiable enough. I think they need to have better systems and metrics, standard operating procedures. I actually think you could go overboard with some of that and become rigid, not move quick enough and be bureaucratic. But in general, most family offices are, they're not, they don't have, they're not rigorous enough in a lot of their operations. And understanding your key performance indicators from the work that I do consulting with families around the world, I think it's critical. So from what you wrote about, what KPIs should family offices track, even using in your wheelhouse, kind of portfolio management systems, and how should they be reviewed? Quarterly, annually, or less frequently?
So this goes back to what I was saying earlier about what are the jobs to be done of an investor, right? You have to ask, what do you care about? Because if your number one objective is don't lose money, that should be an explicit KPI, right? Don't lose more than 10% of the net egg in any given year, or whatever number you think is appropriate. So if your goal is to generate alpha, right, then you should say, okay, great. The metric on which we're going to judge people, we're going to bonus people based on this metric, is your performance versus a benchmark, and define the benchmark, right? Is it going to be S&P 500 or Cambridge Associates VC index or whatever? So this is all idiosyncratic. I think it is very healthy to have an explicit discussion about what are you optimizing for, right? If you're optimizing for, we want to help the next gen to launch a new business. Okay, some people will help you to accomplish that goal. And it's not fair to your staff to move the goalposts, right? That's a terrible way to manage an organization. You should be upfront and say, this is what we're optimizing for.
Excellent. I think we're heading to the home stretch. I'll have a couple of closing words for about a minute. Then I'm going to kick it off to David to wrap it up. It's often not what you see that destroys you, or not always what you don't see. It's actually what you see and fail to do anything about. So parts of our conversation today, I would look at it basically how the world is changing. The single family office of the future, it isn't just a smaller version of today's model. It's fundamentally different in thinking, in processes, and absolutely in tech and mainly in AI and how things are changing. Again, go back and listen to that Ian Cook just from yesterday on January 21st up on my platform. Listen to some of the Dr. Craig Kaplan interviews. And I get it. It wasn't really good, the 10 minutes that he came on as a guest with Ray Kurzweil. But there's lots of good content. And outside of me, Mark Andreessen, Peter Thiel, and so many others, Jeff Bezos, that are talking about all of this and how the world is changing. And I'm just afraid that family offices, from everything from the investing front to the operations to broader from a societal perspective, are just going to be late to the game. And what advantages a family office would have building more of this process and technologies internally, knowing what to selectively outsource and learning how to become a leaner, more effective organization. To think this is not going to happen is just complete ignorance, and your head is in the sand. It's being an ostrich. Now is the time. That's why I'm so active talking about this, and more so in person than ever. Maybe some of you as a family office could join us today in New York City, Miami, January 27th through 29th. My program in late March, I don't want to give all the details now, but the family offices coming to that, wow. Like, this is a rock star list, including some of the iconic VC family offices inside these iconic people. There's like so much amazing things going on. It was great to have David on. Again, go to angelorobles.com and basically join. When you join, you get everything. You kind of own me. You get me 24/7. It really is like a consultant without being a consultant, because it simply is an annual membership. Now, there may be certain projects where it may need to up into a consultative relationship with me and my network. And again, the Ian Cook interview from yesterday will be helpful, especially on an AI build in terms of understanding that. So I look forward to your participation in joining and being part of the club. And I didn't even mention maybe the most important aspect, amazing peers and fellow members and your interaction with them. but you got to be an active participant. Don't just be passive. Go to angelorobles.com, learn more, and sign up, of course, today. David, I'm going to give the final words to you. It was great to have you on. Incredible insight. Maybe a final word if you want to give one. And also, how could people learn more about your work, your services, and how they could follow you or reach out?
So a little bit about me. I am partnered with Coolwater Capital. We are a GP seeder for emerging fund managers, mostly VC funds. So we run an accelerator for fund managers. We've graduated over 250 funds, which have raised over $3 billion collectively and invested in over 8,000 companies. And we invest in those fund managers. I run two communities, pevctech.com, focused on helping investors in the private markets use AI tech and analytics to generate alpha, and foundersnextmove.com, which is for tech founders in transition. We have a whole set of free resources to help people figure out what comes next, coming out of my own career as a serial founder with 2 exits as CEO. All my communities are all free to join. We provide a ton of free content for folks who are in those 2 particular markets. So you can reach me via those websites, and I look forward to hearing from you all.
Thank you. And again, I've known David for over 10 years. He's spoken at some of my events when I was founder and CEO at Family Office Association. I hope to see him in person this year. He's always been very thoughtful and incredible with some introductions that he's made to me that have been very, very helpful. So always appreciative of David. We'll definitely have him on again later in the year, because a lot of this relative to tech, to AI, to VC. So, and I forgot, was it Andreessen or Musk who said what's going to happen the next 10 years is like condensing 100 years. So in the worlds that we're talking about, even having David and others back the latter half of the year, 6 months, 9 months out, it's going to feel like 3 or 4 years or more of progress. So much is going to be different, and hopefully in a positive way. It's not all negative. We have to be optimistic and look at opportunities in the community and space as well. Everyone, I'm Angelo Robles. I hope you're enjoying the content. Subscribe on my platforms, mainly on LinkedIn and on YouTube. I do a little bit on X. I hope to do more. And again, angelorobles.com to really be an integral part of the private club. Thank you all so much. David, again, thank you for being a great guest. Look forward to seeing you soon.
Take care. Bye.
Thank you. Bye.